Hello. I've been seeing a lot of inspirational, motivational, go getter posts on social media about creating generational wealth, creating a legacy to leave for our children, starting businesses, teaching our children how to run businesses. And I'm so grateful for the mindset shift that is taking place. And while that's inspiring and it motivates me, I've also seen a lot of misconceptions also floating around on the internet. But I mean, that's just like anything with the internet, right? We can't take all of our information from a meme and just take that as the gospel good news and run with it. We have to make sure that we're always fact checking, always making sure that we have our I's dotted and our T's crossed. So, before I get into this tax strategy that I've been seeing circulating around the internet, let me introduce myself. My name is Timlin Bowens. I'm an enrolled agent and I'm licensed through the Internal Revenue Service. I'm also the owner of Bowens Tax and Bookkeeping Solutions. It's a virtual firm based out of Louisville, Kentucky. We specialize in empowering taxpayers, specifically 1099 earners, to follow their passion while we maximize their tax savings using tax planning. So this tax strategy going around, it really interested me and I was happy to see people talking about it. But one thing I observed is people were taking little bits of it and just running with it, or they were leaving holes in the information that they were passing. So what I wanted to do, I saw one a couple of months ago, and I wanted to just make a video or post, short post, and just kind of fill some of the holes. Because when people are going to use these strategies, I want to make sure that they work well and efficiently. Because it is true, other people are using them, but they're going and doing the research to make sure they're doing it correctly. So, the strategy that I want to talk about today is hiring your child as an employee. And I'm going to read the actual post because I don't want anybody accusing me of adding anything to what was said or taking anything away. So, the first post I saw, like I said, it was a couple of months ago. It reads, if you have a business and kids under 18, you can pay them up to $12,000 a year, deduct it from your tax return, and they owe no federal tax. This post spread like wildfire. I mean, I saw it everywhere. By everywhere, I mean I'm on Facebook, YouTube, Instagram. I'm not on Twitter, but I think people were telling me they saw it there. And what people did was they took the no federal tax and they said there's no tax at all, which the post clearly states no federal tax. That is to an extent correct. However, it didn't take into account people. I'm sorry, the post didn't say no tax. People didn't take into account the state and local taxes that their child would still have to pay. So that was a couple of months ago. Last night, yesterday afternoon, I was on Facebook and in a local group here in Louisville, Kentucky that's on Facebook, I saw another post circulating and someone asked if it was true. And when I responded, I said, kinda. And I took the time to fill in a few holes and give a few more facts about the strategy. And I said I would make a video if anybody was interested in learning more. And there was a great response. So that's why I'm making this video. I'm going to share it in that group, but I'm also going to share it with you as well, because I feel that everybody should know how to utilize these strategies. So same as with the other post, I'm going to read this because nobody's going to say that I took away from what was originally said or added to. So this one says, you can have an LLC and put your 7 to 17-year-old on the payroll tax-free, up to $12K a year. She does not have to file a W-2 or a 1099. In addition, you will receive a tax write-off for paying them. Things the rich already do. Imagine paying your kid $200 a month tax-free into their own bank account. And when they want shoes, clothes, food, etc., You write off for money you give them anyways. I'm sorry. You can pay with their own card. Now you're getting a tax write off for money you give them anyways. But these tax idiots will never tell you this. Yes, it did say tax idiots. I didn't make that up. Um, Initially, when I first saw that line, I was like, I'm not going to help anybody. I'm not going to make a video. Go let them do what they want to do. Quite frankly, I can agree. Not all tax preparers, advisors are the same. What I will say is based upon the complexity of your tax return. So if you have a business, there are certain credentials that you should look for in a tax preparer. If you have investments, there are certain credentials you should look for in a tax preparer. A person that just does the data entry for if you only have children in a W-2, they're not really a tax strategist. Like you get what you pay for. And I mean, there are some people that are tax strategists that wouldn't tell him this. So maybe he did actually run across the tax idiot. I don't know. I'm just going to give him that one. Okay. But I can tell you with my clients that have children and they're teaching them alongside them of how to operate things, I always mention this strategy. There are a few holes here um, that I'm going to address, but salute to this person for creating the post to make you all start thinking about it and to, like I mentioned, capitalize on the different tax strategies that are available to you. Before going out on my own, I did 3 busy seasons with a bigger firm, and I've seen this strategy done beautifully. Unfortunately, I've also seen where people have heard of this strategy, not done it properly, and it turned into a disaster. So that's why I want to fill these holes. The first post clearly says no federal tax. I've already addressed that. That's good. Post 2, however, says it's tax free. That's not accurate. They will have to pay state tax. So if you're in Louisville, Kentucky, like me, they'll have to pay tax to Kentucky. They'll have to pay tax to the city of Louisville. And if you live in a township like St. Matthews or J-Town, they'll also have to pay tax to them. Um, the next thing, 7 to 17-year-old, the strategy is actually available for a wider range of years. The thing about it, though, the job that you are paying them for has to be reasonable for their age. So, for example, you mentioned 7 years old. You can't put your 7-year-old on the payroll as your executive assistant. That doesn't make sense. Now, you can go younger than 7 if it's reasonable. Excuse me, I'll give you an example. If you make a Facebook commercial with your child that generates revenue, okay? So they're going out there telling about your services and is bringing revenue in, you can pay your child for that. I mean, in the early 90s, how many people watched the Cosbys? You guys really think that Olivia Raven-Symoné was just on the Cosbys and not getting paid? No, she was acting as reasonable for her age and she was paid for it. The next thing with the 7 to 17, the strategy actually can be used for child until they're over 18. The part he says about the LLC, I can't say that is completely correct. Can't say that's completely incorrect because, as I mentioned before, there are a few holes there. So anybody that's worked a W-2 job, when you look at your check stub, you're like, oh man, they took all this money out. You notice that they took out for Social Security, they took out for Medicare, your federal, state, local. Social Security and Medicare is not optional for anybody. So unless you've consulted with a tax planner and you have this set up correctly, your child's wages, even if they're 18 and under, will be subject to Social Security and Medicare. Now, if it's a sole proprietorship, your child's wages are exempt from Social Security, Medicare, and FUTA, which FUTA is the Federal Unemployment Tax Act, which means that any employees you have to pay into unemployment insurance on the federal level. If you're a sole proprietorship paying your child, You're exempt from that because, I mean, reasonably, if you're paying your 12-year-old and you fire them, are they really going to draw unemployment? No, because you're still paying for their expenses. However, if the entity is not set up correctly, you can't take advantage of this, and their wages are still going to be subject to Social Security and Medicare. Now, he says an LLC, and I said a single member, I'm sorry, I said a sole proprietorship, which a single member LLC can't take advantage of it. However, if you have a partnership where the mom and the dad are both partners in the partnership, that is an LLC with the state or joint venture, and you can take advantage of the same strategy. So, as I said, he's correct as if we're going to say that both parents are partners in the partnership and it's an LLC, then you're good to go with it. If only one partner is and it's an LLC, you can't use the strategy. So let me go on to the next part. And I took notes because, like I said, I want to make sure I have the whole spiel, that you have clarification. So if you want to go use this strategy, I strongly advise that you consult a tax advisor. You also want to make sure that you have a lawyer that you can consult. But let's see the next part. Oh, if it's a corporation or a partnership where only one partner is a parent, those wages are not exempt from unemployment tax. Make sure you have your business entity set up right, because nobody wants to pay unemployment insurance for a child that they're going to have to take care of, regardless of if they pay them as an employee or not. Also, if the child is 19 to 21, the wages are subject to Social Security and Medicare, but during this time frame, they still aren't subject to FUTA. So as I mentioned, that is the Federal Unemployment Tax Act, where you pay into unemployment insurance. I think another thing to note here, he says that they don't have to issue a W-2 or 1099. Now, if you're a business owner, I hope that you know already that you need receipts to back up the purpose of any purchase that you made. In worst case scenario, the IRS does an audit, you need those receipts as proof. Well, when you have payroll and you write off employee expenses, you need your W-2s and 1099s to back up that you actually paid employees. That's a form of a receipt. So if you have your child on payroll, you must issue them a W-2 or it will backfire. The whole plan out the window. When you put them on payroll, it has to be legit payroll. So you can't just write a check to your child every week. They're not doing any kind of job. You're just writing them whatever amount you want. No, you have to actually keep legit records, just like if you had any other employee. I wanted to point that out because that is one where people were like, woo, you don't have to do any paperwork. Like, really? Have you ever heard of any deduction that you can get with the IRS without having any paperwork? That's just not how that works. So you want to make sure you do that, because another thing, if you're claiming them as employees and you're not turning in that paperwork, that is a huge penalty that you'll get hit with from the IRS. But another benefit, I think the main benefit that attracts people to this tax strategy is shifting the income on paper, but keeping the spending power within your house. So, for example, let's say we have a sole proprietor. For the sake of this example, let's say that's a single parent. Um, let's say it's Morticia, okay? Morticia sells makeup. She sells a lot of dark makeup, okay? She has a 16-year-old named Wednesday. Now, Wednesday is 16, so she's phenomenal with creating videos, editing those videos. She's a beast on Instagram and Facebook, any kind of social media platform you can think of. So what Morticia does is she has Wednesday do all of that for her, and it actually generates a lot in sales. And I also have this in notes because, contrary to popular belief, I am not a human calculator. So currently, before Morticia comes to me, of course, she's in the 22% tax bracket. because her taxable income, which means her income after all of her deductions, is $63,000. And she's looking at paying roughly $8,400 in federal taxes before even calculating her self-employment tax. For those of you not familiar, self-employment tax for self-employed people is our share of Social Security and Medicare, and it's roughly 15.3%. So anything that you can do to get that down, you will want to take advantage of. So if Morticia lived right here in the Commonwealth of Kentucky with me, she's easily looking at paying $3,000 to the state and almost $1,400 to the city of Louisville. So we're already paying over $10,000 before figuring in her self-employment tax. And somebody's mouth just dropped because it's legit. The self-employment tax struggle is real out here, you all. So entity type, tax planning, once you start making some real money in your business, is something you really want to consult a tax advisor about, because chances are you're paying way too much in self-employment tax, and there are legal strategies to reduce that. So when Morticia comes to me, I'm going to tell her how it is. You already have a child here that's generating sales, running your social media. You would pay another person to do the beautiful job she's doing. So what we come up with is $1,000 a month, which comes out to $12,000 a year. Now, I also want to point out the number being thrown out is $12,000. That's because for 2018, that was the amount of the standard deduction. In 2019, it's gone up slightly. So you can do it all the way up to whatever the standard deduction is to have that wipe out whatever their federal tax liability would be. So if Morticia gives Wednesday this $12,000, we're not only going to reduce her taxable income, so the amount that she's taxed on, we're also going to lower her tax bracket, which means she's not getting taxed at that 22% anymore. So Morticia's no longer looking at roughly $8,400. Now she's looking at $5,800. Her bill for Kentucky just went down to $576, and her bill for the city just went down by $264. For those of you that like to write that down, she's now looking at no longer paying roughly $8,400 at the federal level. Now she's at $5,800. Like I said, roughly, because I'm rounding it. Her bill for Kentucky just went down $576.50 to be exact, and her bill for the city just went down $246. So, so far it sounds pretty good, right? So her total bill together just went down $6,900 just from shifting that income, but the spending power remains in her house. So it's definitely a tax strategy that you want to consider if you are right on the edge of a tax bracket, or if you have multiple children and you already are teaching them the business and you want to be able to pay them. But as I said before implementing any tax strategy, consult an accountant. Make sure they're actually a tax advisor if that's what they specialize in. Many times you'll also want to consult a lawyer. I personally was hesitant on that one. I was blessed to come into contact last year, maybe it was this year, with somebody that was able to help me have access to an attorney 24/7. It's something that was considered more affordable. I'll actually tag her below in this video because I'm sure that she would love to help anybody else that's a business owner out with that. But I hope that in this video I was able to give you some clarification, a little bit better direction of what you need to do to implement that strategy correctly. If you have any questions and you don't want to leave them down in the comments, feel free to shoot me a message. Or if you have any tax strategy that you would like me to address in another video, please feel free to email me at inquiries@Bowen's Tax Solutions. Again, that's inquiries@Bowen's Tax Solutions. So thank you so much for tuning in. If you leave a comment, I would love to engage with you and get to your questions down there. So until the next video, bye.